Hello there. Thank you for joining me. Thank you for joining me. It's Luosi Indexes, and I am so happy that you have joined me for this awesome video. And I would love to thank you again for joining me. Before I go on, allow me to thank my mentors, Robert Kiyosaki, who wrote the book Rich Dad Poor Dad. Also, allow me to thank Timothy Sykes, who wrote the book The Penny Stock, who wrote the forward to the book The Penny Stock Guide. And then also allow me to thank Matthew Crater, who wrote the book Rocket Stocks. And you can find all their books on Amazon Kindle or paperback. Now, I'm here to talk to you about, as you can see here right now, indexes. Now, Dow Jones is a very much a good buy, and you're probably wondering why. Well, in my previous article, if you're a member of the TradingView community and you follow me on TradingView, I did write down the reason why. So I'm just going to break it down in this video as to why exactly this is actually a good buy. Now, I want you to, if we draw back to the monthly chart, hopefully it will work. Okay, can we go back weekly? Sorry, guys, my internet. All right. Hey, I'm trying my best to offer you the best service with the internet that I have, but we'll get through. We'll get through. All right. Now, if we go back to 2020, 2020 was the previous bear market, and it was a terrible bear market. I still remember this bear market because this is the bear market that oh my goodness. 2020 was the bear market that really helped me. It made me, at that time I did not know how to trade. I was getting into online business and learning digital marketing because I honestly believed that I was going to master digital marketing. And that was 2020. And I was really into digital marketing. And, you know, it was I'm sorry, I thought I heard something. Okay, so 2020 was really a very difficult period in my life, and by then I did not know how to trade, and so it was that thing whereby, just excuse me as I wear my speckities. So 2020 was really tough time for me, and hey, what has happened? Okay, it's like magic, eh? Okay, 2020 was really a difficult time period in my life, and it was that period whereby I was still learning. I was still trying to master trading, and because of that, it was that thing whereby you know I was trying to get into digital marketing, and then things didn't go well with a partner. With a partner that I had who was supposed to help me with my digital marketing. And I remember during this time here in 2020, because at that time, around that time, I was mastering Facebook traffic, and this was the time when Facebook traffic, because I mastered search engine optimization. Then I used my search engine optimization skills on Facebook platform, and immediately Facebook started banning all the search engine optimization traffic experts from their platform. In short, there was no longer organic reach. Like, one example I can give for that is TikTok. TikTok has still got organic reach. So if you're into search engine optimization, I would encourage you to do TikTok. I would have done TikTok, but I'm working on another business project for using my search engine optimization. So that's my skill, search engine optimization. That's my traffic skill, search engine optimization. But and then I later on mastered Facebook marketing and email marketing. So I have three digital marketing skills. So it was during this time that I had to learn digital marketing, and Facebook started banning all the search engine optimization traffic people. Basically, there was a lot of complaint about spam, so it was terrible. And then around this, so this period is what led me into learning how to trade, and I studied trading super hard. By the time we reached this bear market, this I think this was around the FTX crash, some bank and all those guys, FTX, and what's the name of that other one? I don't know if it's SBF or something. This was the other banking crisis that happened. This was the crypto market crash. This market crash affected the crypto industry, and it was terrible. It was really, really terrible. And as you can see, we're still recovering from that. And if you are still in the stock market and you're watching this video, congratulations, you still have time. And so that's why you need to know the rocket booster strategy. Okay, now in the rocket booster strategy, the price has to be above the 50-day moving average. On the daily chart, of course, the price has to be above, on the daily chart, the price has to be above the 50-day moving average. And then, which is what happened here. Okay, that's the rocket booster strategy. This price has to be above this 50-day moving average. And then the second thing is the price has to be above the 200-day moving average. And then the third thing is the 50-day moving average has to cross the 200-day moving average. And that will indicate a buy signal. And this is what's happening right now in the Dow Jones market. And then finally, before we conclude on the strategy, that's how the strategy is, by the way. That's rocket booster strategy. It's very easy. I'd encourage you to watch my previous videos just so that you can embed it in your brain. Okay. We can look at the news. Wall Street edges lower as investors await more policy cues. Wall Street muted at open as investors await more policy cues. Global equities ahead. Big monthly gain, dollar falls. We can look at this news here. Now, according to this news by Reuters, November 24th, 2023, it's in relation to the dollar. So basically, what they are saying is the DXY, which is the dollar index, has fallen. Now, what you need to understand about the interest rates, which the Federal Reserve is going to try to drop, is companies right now need to borrow money, so they have to drop the interest rates. When the Federal Reserve drops the interest rates, this allows businesses to borrow money. And when businesses borrow money, they can use that to develop their companies. And the companies that are hoping to develop are found in the Dow Jones and the S&P 500. Okay, so that's the whole game here. And what it is they borrow money, they develop companies, and then they invest in gold. Okay, gold futures. So you can see even from here, gold as well performed very well. Gold futures performed very well. As for oil, there seems to be an oil output cut. So the OPEC organization is going to be meeting to discuss further how the oil market is going to be affected. And then right now, the Dow Jones is rising as according to this news. So is the S&P, which gained 2.72 points or 0.6%. And the Nasdaq dropped. Then, as you can see, the Euro stocks as well did gain 0.4% on a Friday, close to higher on the second week. So you can see that there's this perpetual thing going on where the indexes all seem to be up on a certain rise. Like I said before, businesses they they need that dollar, all right? They need that dollar. That dollar is what they are going to use to invest back into their companies. And so the Federal Reserve has to drop interest rates, okay? The Federal Reserve has to drop interest rates to make the dollar cheaper. All right. So as the Federal Reserve's interest rates rose up, this forced companies to stop borrowing the dollar, and this is what caused the poor performance in the index markets. Because what you need to understand is they're borrowing money, developing their companies, developing their workforces, and then using part of that money which they borrowed from the U.S. Central Bank to buy back their shares in the market. And the DAX closed up as well. So as you can see, there seems to be a correlation with the indexes, the index market. So as you can see from here, like I was saying before, the U.S. Central Bank has raised the benchmark borrowing cost by more than 5 percent points since March as part of a global monetary tightening cycle. So this is very, very important because this is very important for you to note because again, the US Central Bank is the biggest central bank right in the world. All right. And so their interest rates are very important. So as they start dropping those interest rates, what you need to understand is that the drop in those interest rates makes the dollar cheaper. So it is cheaper now to borrow the dollar. It is cheaper now to get dollars and reinvest back into their companies. But this does come, unfortunately, at the cost of socialism, at the cost of the economy. So at the cost of society. So it is during this time when the Federal Reserve drops interest rates that the society suffers because when the central banks make money by raising interest rates, they take some of their profit and then they when they take that profit, they give it to the public. All right. So basically the central bank belongs to the public, right? So they take some of those profits that they make and they give it as savings to the public, right? So probably by now your savings accounts are in danger right now. It would be very, very dangerous to save your money because the cost of borrowing is going down, which will lower the value of your savings. And that's why the price of gold is obviously going up. And then here it says, but the debate is whether we should be taking profits now, added, given the potential for a re-acceleration of US growth after the world's largest economy bounded recession forecasts throughout 2023. So United States was basically the United States was denying the existence of a recession. No, we're not in a recession. No, we're not in a recession. And now you find that after the markets have kind of recovered, that's when they seem to be like freely trying to re- review, like trying to like let the public know that yes, there is a recession. after the market recovery. But all this while, there was a deadly recession. Then, as you can go down here, the U.S. Treasury yields, U.S. 10Y, which set the tone for borrowing costs worldwide, rose to 4.4%. So the U.S. Treasury, usually these are U.S. central bank assets. No, not U.S. central bank. Sorry, these are U.S. government assets brokered by the U.S. central bank. So what is happening now is the global when the interest rates drop, the global market is going to borrow the US dollar and then buy their treasuries. Okay, they're going to buy back their government bonds. But eventually, at some point, they will stop, they will sell those bonds to the public. So, ideally, what those countries will do is they will buy their bonds, let the price rise, and then when the Federal Reserve starts to raise interest rates again by artificially increasing the value of their dollar, they will sell those bonds back to the public at a loss. You so I don't know why they buy. I don't know why they keep doing this. I really don't know why global economies keep buying an asset that's dropping in value because honestly, it's like they're stealing wealth from the economies. So I don't want really to go much into it, but the perfect way I can explain it to you is why would you buy an asset that's dropping down in value unless your aim is to make money on the commissions? Because what you need to understand about commissions is that commissions are like a source of cash flow for Wall Street. Commissions are the source of cash flow for bankers, right? Bankers don't care about what assets the governments or the nations of these countries invest in. They don't care about the return. All they care about is the bank fees and the commissions. Commissions go to Wall Street, bank fees go to the bankers. So these countries around the world are buying US treasuries at a loss. And the bankers and the inside traders are making money off insurance and banking fees. So this treasury yield rise is good for the short term, but it's not good for the long term. U.S. Treasury bonds are not an asset. They're not a good long term asset. If you want to short them, yes, maybe, but you have to be an insider. So the article goes on to say minutes from the latest Fed policy meeting signaled that there would not be more hikes unless progress against taming inflation faltered. So as you can see, there will be no more rate hikes. So what does this mean? It means the public is not going to benefit from the central bank. They will not benefit from savings. Let's go down. It's a very powerful. I don't know how much we have left. We still have a lot to go, but no pressure. We can really break it down. It goes on to say Germany's 10-year government bond yield, the benchmark for the euro area, rose 3 basis points to 1-1.5 week high. So it's the same game, and you can see it happening over and over again. You can see it happening over and over again, where these countries are buying their bonds, knowingly deep down that they will crash, making money off the short sale and the commissions. And this is not very wise. That's why it's not wise to save, because what you need to understand about bonds is that they're backed by the savings, the public's savings. And the reason why bonds are no longer good for some countries is because of the debt ratio of that country. So some countries, the bonds are good, right? Like there are some good African countries that have good bond yields, but the bond yield is basically backed by the debt ratio. So you look at the country's GDP to debt ratio. So if the country's GDP to debt ratio is good enough, then it's also a sign that they are born.